Hello and welcome to this week's episode for SPY Trader Now. Today is March 29th, 2023. Our model portfolio is up 5.28% year to date. If you are watching this video, you are interested in how I, a 20 plus year veteran of trading the S&P 500, does with my model portfolio and how I trade the market. And the buy and hold investor is currently beating us this year in 2023. The buy and hold investor is up 8.62% year to date, and we're only up 5.28% year to date. So we're trailing, and we need to catch up. And my goal is to, by the end of the calendar year, is to beat the returns of the S&P buy and hold investor. And if you want to see my trading style and how I do that, you go ahead and stay tuned. Past results of my trading for 2022, up 21% compared to the buy and hold investor, down 19%. And here's some other previous years. 2020 was a fantastic year, up 100% compared to a 15% return for the buy and hold investor. Go ahead and hit that subscribe button, ring that bell, and smash that like button down for me right now. This is a one-year chart of the S&P 500. We're going to go through the charts in much greater detail later on in the video. On this day right here, which is a candlestick right here, it's very hard to see here, but I'll show it to you in other charts. That's where I made my last trade, in which I purchased a one put contract, $370 strike, expiration date June 21, 2024. Went out over a year, but that cost me $16.50 for that put. Last week, this is a weekly chart, 5-year chart of the S&P 500. Last week, the S&P 500 gained 0.9% for the week. Here you can see that kind of double top formation pretty good in the weekly chart. Again, we'll show you this later on in the video as well. And here is that trade that I made during the week. The alert went out on Monday, April 24th at 9:52 a.m. on Pacific Standard Time. Here is my trades that I made for calendar year 2023, including the last trade that I made on April 24th. That trade is still open, but for the purposes of this video, so I could come up with a current valuation of my portfolio, I put in that what the option price was end of trading day on Friday, 4/28/23, just so that we could see how well I'm doing. I'm losing $103 in that put option trade that I made. The portfolio is currently, we start each year, by the way, at $100,000. So we start the calendar year off with $100,000 and we see how well we grow from there. We're currently at $105,278.60, which even includes the $103 loss that I am taking on the current valuation of that put trade. If you want to see all my trades going back for the last 3 years, you can head over to spytradernow.com. You can sign up for my real-time trade alerts, and if you have not done so already, go ahead and hit that subscribe button, ring that bell, and smash that like button down. Here is my equity curve for my model portfolio for year-to-date 2023, and you can see how well the portfolio has fared. This is the equity curve for the S&P 500 buy and hold investor for 2023. And here are the two equity curves combined, with the pink being the buy and hold investor and the blue being SPY Trader Now. So you can see that the buy and hold investor has, really, gone up, gone down, gone up. It's wild swings, so to speak, as opposed to my portfolio, which is a little bit more slow and steadily rising. Doesn't have that wild swings to it because I have a more conservative trading pattern. Here's the Fed rate increases that the Fed Chair Jerome Powell has made starting in 2022 to today. And the last rate hike was done on March 2nd of 2023, 25 basis points that brought the fund's Fed rate to 4.75 to 5%. We know the terminal rate is supposed to be between 5 and 5.25, so we have more Fed increases, rate increases to go. The next announcement for the Fed meeting is going to be on May 3rd. That is Wednesday of this week. Jerome Powell is going to make an announcement of where we stand on interest rates. There's a high probability that there's going to be another 25 basis point rate hike on that announcement. That's already baked into the cake. The market is fully aware of that rate hike. So that's nothing to be worried about. What we want to know is the announcement followed with the that he's going to make followed with the rate hike. Is he going to have a dovish tone? What type of a tone is he going to have with his announcement? And how many more are there going to be more rate hikes, or have we already reached where we're going to have the Fed pivot, or he's going to stand fast for a little while? That's going to be the important part. And what's more important than that is how the market reacts to whatever he says on Wednesday. That will be the prevailing trend for the short term. We'll get that trend direction on Wednesday. Judging from the last 2 days, you think that is going to be a favorable trend. This is just a guess at this point in time because we're not at Wednesday's announcement yet. Now we are looking at things from the bond market outlook, and we want to pay attention to the bond market because the bond market is 4 times the size of the stock market. So, and you have a lot of smart players in the bond market. The bond market currently has an inverted yield curve, which is not normal, meaning that the shorter term treasury rates are at a higher interest rate than the longer term treasury rates. So the 3-month and the 2-year yields have a higher yield than the 10-year yield. In addition to that, we have rising interest rates. The 10-year 1 year ago was 2.77. The 10-year today is at 3.4. You can see that here. You can get that from bankrate.com. There'll be a link down below if you want to explore this on your own. The point is that the bond market is telling us as equity investors to be cautious. So this is not a time to go, let's use the term all in. It's time to be a little cautious on your investing when you have an inverted yield curve and rising interest rates. Not the most favorable stock market times for investing. Here is valuation according to currentmarketvaluation.com. Here's the link, and there'll be an actual link down below in this description if you want to click on it and go directly to that website. But they're telling us that we are currently overvalued, and we're overvalued by 43% according to the market era. And this is for the PE ratio. On the standard deviation chart, on a valuation, we're at a +1 standard deviation. So we're up there. We can still go higher, but caution is advised from this perspective. Fear and greed index currently at 60. 1 week ago, the fear and greed index was at 63. Fear is coming down in the market. I'll show you that in the VIX chart momentarily, but you can see it here in this chart as well. Now we're looking at a seasonality standpoint. From a seasonality standpoint, we just closed the month of April. No more trading in the month of April. Now the trading is going to begin in the month of May. In the month of May, there's a 74% probability, going back from the last 20 years of data, that we are going to close the month higher than when we opened the month. The month hasn't even opened yet because the month begins on Monday, and I'm producing this video over the weekend. Last month, for the month of April, the market had an increase of 1.6%. That's this candlestick right here for the month of April. Now we're looking at a 20-year chart, S&P 500. Great bull run that we had since that market meltdown, the mortgage meltdown 2008, 2009. Nice run. Then we tapered off, but we broke out of it recently. As long as we stay above that line right there, we are in a bullish configuration. MACD and slow stochastics are supporting that we're going to do that. But we're monitoring this to see if we are indeed doing that. Because if we don't, we start to roll back over, that's going to be a completely different picture. From an intermediate term outlook, you can see that double top formation right there. This is weekly bars going back 5 years, S&P 500. You can see that downward megaphone pattern we were in. We broke out above it, and we're still above it. As long as we stay above it, we're in a fairly bullish configuration. MACD and slow stochastics are favoring that, but right now we're at a resistance point. Are we going to break out of it? We don't know. You have a resistance point here and here. So right at this approximate 420 level, or just below it, 417 to 420. So there is resistance in our current configuration. Now we are looking at it from a daily short-term outlook, 1 year chart. We were in this very nice sloping upward trading channel. We broke out above it, came down. This is when I got the put. We got some softening, but we met support way too early for me to sell the put and take profits on it. I held on, and then the last 2 trading days caused my put to go from profitable to unprofitable, and now I'm down $100 in that particular put contract that I have purchased. The MACD and the slow stochastics look like they want to take this market higher. Now we're looking at the same daily chart, but instead of going back 1 year, it's only going back 6 months. So you can see the bars a little bit more clearly. You can see those last 2 trading days a little bit more clearly. One bullish thing about these last 2 trading days is the size of the bars. Not big bars like that is very bullish. Volume looks above normal. So we might have the energy needed to bring this market higher. Now we're looking at it on the VIX, the volatility index, the fear index. We're at rock bottom. And the VIX works inversely as the stock market. The stock market is this black line. The VIX is here with these candlesticks. And when you're down here at a low reading on the VIX, that's when the S&P 500 begins to back off a little bit. So we're at rock bottom right now. So if the market was to, the VIX was to come up, that means that this level here is going to come down. So when the VIX is at these low readings, that's when I put down here, that's when you want to sell the S&P 500. You want to buy the S&P 500 when the VIX is way up here. When the VIX was here, that is, and it was starting to drop down, that is when the S&P 500 came up nicely. So that's your easy money to be made. Right now, this is not easy money because there's a higher probability of the VIX going up, meaning the S&P 500 is going to come down. So we want to monitor this. Now we're looking at the 1 year chart of the 1 year daily chart, S&P 500 on the Thinkorswim platform, which is my broker, TD Ameritrade. This chart has standard deviations, +2 and -2 in gold, +1 and -1 in pink. And we're currently at just above the +1. And you can see the last couple times, 3 times, we were near the +1 standard deviation. We came down. We're here, we came down, but not by much. And then we came back up. So it looks like it can still go higher like it did here, but it's going to top out at the +2 standard deviation, so you have limited growth. There's a higher probability. There's a 67% probability that you've peaked right now and it's going to come back down. So the odds favor that we're going to go sideways to down from our current value, from our current market price point at 415.93. We're looking at the same chart now, but instead of going back 1 year, it's only going back 3 months, just so you can see the bars a little bit more clearly. There's your +1 standard deviation, and you're at that high right there. So this could be a double top. We could do what we did here, and we could come down or move sideways. But the market is showing signs of strength, but that strength came in only 2 days, and it came with a limited number of stocks. Not the entire stock market. There's just a few stocks, large cap mega stocks, that are carrying this market right now. If those were to crumble, this whole this whole house of cards is going to start to come down quickly. But right now, the market is absolutely loving these stocks, as you can see in the trading action. I just gave you a ton of information in this video. Now comes the critical thinking. What are you going to do with all that information? As of March 29th, 2023, market summation, according to me, I am your host. My name is Ken, and I am Spy Trader Now. The market is at the +1 standard deviation and should either go sideways or down from here. Odds favor. It's not a guarantee, it's just odds favor. If the market does go up, it's limited on short-term growth, as I showed you with the standard deviation chart. We are still holding our one put contract that I'm going to leave in place for now because the odds favor downward movement in the price of the S&P 500. And if we get downward movement in that price, that loss of $100 is going to go to possibly break even or profitable, depending upon where the market meets support. But that hasn't happened yet. But I've got such a long put expiration date, I can hold that and still not really worry that much, because my expectation is softening at some point in time for the market to pull back to some level. That will hopefully get me in a profitable position on that put. So what I'm thinking about doing now is adding to my positions by selling to open 2 cash secured put contracts, which have just a 1-week expiration date, 5/5/23, with a strike of 404. When you look at the charts, there's support. That last time that we dropped to about 404 on that price point. So the market it's going to have a sticking. It's going to show some more support at that level. So the probabilities of going below 404 at this juncture are low. Currently, we're at 415.93. So there's tons of leeway. There's actually about 3% price protection if I was to take this option. The only problem with this option is that it's only currently paying 51 cents, and it's only going to give me an annualized return of 11.5%. I do not like doing cash secured put contracts where my annualized return on investment is less than 20%. But I've got some really good protection, so I might actually do that. I'm going to see how the trading goes on Monday. This is what, when you put the trade into my broker's platform, this is what it actually looks like for the actual trade that I'm potentially going to make on Monday. I'm going to wait. I'm going to see how the market looks on Monday, and if it's close to where it's at now and moving sideways to nowhere, I'll just take this trade and have some skin in the game. It's in cash right now. I've got 80,000 in my model portfolio, so I can put that money to work and I can get $102, which ironically is exactly how much my put contract is down right now. So just by taking this trade, I could wash myself out of that loss. And if the market comes down 3%, that put contract will actually go profitable, and I'm still going to pocket the $100. So let's just see what happens. I got to see what happens on Monday, but this is my game plan, folks. This is what I am thinking and what I am planning on doing as on Monday. So that's where I stand. I hope that you got some valuable information out of this video. If you have not done so already, hit that subscribe button, ring that bell, do me a solid, smash that like button down to help me promote this video. Head over to Spy Trader Now to learn more about me. To get this cash secured put calculator for free, you can do so at spytradernow.com. And if you want to sign up for my real-time trade alerts, you can also do that at spytradernow.com. I thank you, and I wish you good trading.